Hey, welcome back. I want to talk a little bit, short video about insider trading and some of the crashes that occurred over the last few decades. Insider trading, as many of you know, it's when someone has material, non-public information. So they know something that, a company's about to get a patent, or they're about to not get a patent that everyone thought that they were, and the market baked in. So it's information that, somebody at the company may know. And if they pass that information to you and you trade on that information before the public has it and you make money, that's illegal. That's insider trading. An informed trader, which is what most of us are, all of us are probably, we trade based on public data. So that's an informed trader. Key point there. You'll see an article in the book for those of you that know Martha Stewart. Most of us do. Martha Stewart, very well off, great companies. She was indicted and went to prison for insider trading for a few. I don't think she went for very long, but she definitely broke the law and went to jail. There's some information about how she obtained that information and what she did with it. So you got to be very careful there. There's another key point in here about circuit breakers. So we have these bubbles and we have these crashes. So a bubble, I'm just looking in the book here. The bubble occurs when market prices soar far in excess of what is normal and rational analysis would suggest. A lot of you know about these kinds of bubbles. I'll talk about them here in a little bit. And then a crash is a significant sudden drop in the market. So these occur, at the end of a bubble when a crash occurs and the market just, drops into the tank. If you've never seen the movie The Big Short, I would recommend to watch it. It's fascinating. It really centers around the 2007-2008 market crash and the financial problems that we had, the financial crisis that we had in the market or in the country. And it's about mortgage-backed securities, so that these traders were creating these huge tranches of mortgages, and the mortgages were crap. But no one was rating them that way. They were rating them as AAA, great investments. People were buying them. And then as soon as someone at one point figured out that these mortgages were going south, the whole market tanked. And that's really what a bubble is. Everybody thinks that everything's so great, and then when reality sets in, the market, which has been inflated so much, drops. A lot of you may or may not remember the dot-com bubble, which was right around 2000, or the year 2000, 1999, 2000. Where companies just came out and they put a .com after their name, and all of a sudden people thought they were a great company, and the market just soared with all these people buying these small companies. And then at one point the reality set in that most of these companies were not profitable companies. They were startups. They were not what they said they were. And immediately once that hit, the value dropped and very, very significantly. It's since returned to normal levels, but you can actually see these things on the charts. So take a look at those. Be aware of the crashes and the bubbles. And they're going to talk about something called a circuit breaker. And when these things occurred, what they're doing now with the electronic trading is so for instance, the S&P 500 has a circuit breaker in there. If the market were to drop 20% in one day, the market shuts down. It ceases trading for that day, and that's a way to kind of keep the market from having an extended loss period, so people can kind of relax, rethink what's going on, be a little bit more rational, because when those things happen, people just panic and trade and sell and do all of those things. So read about those circuit breakers. There's different levels of them, and so those are for really our protection as consumers out there, and to get everybody to kind of take a pause and really think about what's going on, because sometimes these markets can get out of control. And I guess my last thought for you is this. As I get older, as I listen to the news, as I read the internet, as I read the Wall Street Journal, the reality is that a lot of smart people are wrong a lot of the time. Nobody can predict the future. Everybody can say that they know what's going to happen, and they're on TV and they're predicting what they think is going to happen, and sometimes they're right, but sometimes they're wrong. Even the Fed and all the interest rate discussions that are going out on the internet, nobody knows what's going to happen. And the beauty is, and what I think is we're seeing a little bit more of right now is folks are are stepping back and using as much data as they can to make decisions. So again, doesn't matter how smart you are. Sometimes you get lucky, sometimes you won't. Smart people can be wrong. There's a lot of people on TV 24/7 news cycles that are just talking. Don't put too much stock in these things. Do your research. Go with the probabilities. Save your money. And good things will occur over time. But don't get too caught up in the trends and in all the noise that's out there. So hope that helps.